Welcome to Do You Ever Wonder? The show that brings you answers to many of the questions that you may have, but with no one to ask. Do You Ever Wonder is hosted by Mike Haltman, CEO of Hallmark Abstract Service, who, like you, has always been deeply curious about a wide variety of topics. Each week, Mike will be speaking with guests who are leaders in their field and who have inspirational stories to tell. So now, sit back and enjoy the show.
So, hello everybody. I got to tell you, I'm extremely excited about this show because everything you thought you knew about investing and finance, basic principles of investing, I thought I knew those things, but my mind was blown, and prepare to have your minds blown. So, just a little background: I came from the traditional space. Got an MBA in finance. I was a bond analyst. I was a bond trader. I was an equity trader. And I thought in terms of the traditional types of investing. You take a risk tolerance test. You create a portfolio based on your age. And as you get older, the mix of stocks and bonds gets a little bit different. More bonds, less stock. Portfolio structure was very, very important. But then I spent 2 hours with today's guest, Jonathan Blau. Jonathan is the founder and CEO of Fusion Family Wealth, and my mind was blown. He's a behavioral financier. He runs a hedge fund. Well, he runs a
money management firm.
Money management firm, and fascinating. And he'll when you're done with this podcast, you tell me if your thoughts have changed a little bit. So welcome, Jonathan.
Well, thank you, Mike. I really appreciate you inviting me on as a guest today, and look forward to discussing all the topics related to behavioral investment counseling that might interest your audience.
So number one, how did you go from, because at some point in your life you were probably into traditional investing, how did you become more of a behavioralist?
So I guess necessity is the mother of invention, right? In this case. So early in my career, after having left the accounting world, having worked with Arthur Andersen, one of the former Big Six accounting firm, I went to a firm called Sanford Bernstein and Company. It's the largest privately owned money management firm. And in the was 1997 when I got out of their training program that I joined in 96 and became a full-fledged Bernstein advisor, and worked diligently for the first 4 years to raise approximately $100 million in assets to manage that people gave me their confidence to do. And in 2000 to 02, I watched it turn into 50 million from 100 million quickly, in the face of the dot-com bubble bursting, followed by the terrorist attacks, 9/11. And what I learned is I spent a lot of time. I was 29 years old at the beginning of 97, and I spent a lot of time walking people emotionally off the same cliff I walked them off a month earlier, 2 weeks later, a day earlier, and then the same day today, same cliff. And I said, there's got to be a better way to help people than to just repeat the same thing about the market will get better and these things happen all the time and so on and so forth. It was very reactionary and very ineffective in terms of helping people gather their temperament to survive the bear markets that they're going to face over their lifetime. So I just thought about it. And in the training program in 96, there were 2 days on behavioral finance. And behavioral finance was basically shown to the financial world in its modern version by a guy named Daniel Kahneman, who talked about decision making under uncertainty. He passed away this year. He won the Nobel Prize for his work there. And I was very intrigued by it, but I still didn't pursue it. It was in my mind. I didn't pursue it. Then the market fully recovered by 2006, 2005. And then 2008, we lost 60%. So we lost 50% from 2002, 60% from 2008 to 9. And I said to myself, again, I was onto something back in 2000 when I said there's got to be a better way, because I found myself talking to the same people off the same cliff every day in 08 and 09. And that's when I said, what I've got to do is I've got to help people to learn what to expect when they're investing. That every year the S&P goes down about 15% on average, literally since 1980. And then at 1 year in 5 or 6, about 33%, twice that amount.
So you
And I
found that
learned
emotions were driving people.
completely, yeah, emotions and the way we were just, there's two things that drive us, the emotions and the way we're hardwired to make decisions. We're hardwired not to make decisions that are going to yield the best long-term financial result for us, but really to make decisions that are giving us the smallest chance of short-term loss and the biggest chance of short-term pleasure. And those are the opposite things that we need to be programmed to do to succeed as long-term investors. So
Yeah.
I'll talk more about that. But what I did then is I really got deep into behavior. I learned it and spent quite a few years. I didn't really perfect it from my perspective to be able to be helpful to clients with it in terms of communicating it and letting them know how we can help them with it until about 2015, 16. And I started really delving deep into it by 2010. So it took a long time. And what I learned is that we have two sets of systems that are flawed. One is our belief system and one is our behavior system. So the belief system, the two main flaws are we believe that money is currency, when currency is not money, it's currency. It's a medium of exchange. It's probably a peerless medium of exchange. So I don't have to ask the car dealer how many financial plans I've got to give him for the Tesla. I can give him the money. But really, currency doesn't store value. Uh, the average advisor and the average investor views the currency unit, the $100 bill, as a store of value. So when they sell their business for $10 million worth of $100 bills, they come to someone like us and say, whatever you do, I can't lose it. You've got to make sure you protect my money. I can deal with lower returns, but I can't lose my money.
Principal preservation is a big buzzword in the industry.
That's right. Got to preserve my principal. And by the industry and the average person culturally here, measuring risk and safety in terms of protecting their principal, and not just from disappearing, which in a diversified portfolio, like for example, the Standard & Poor's 500, never has happened. We're basically at all-time highs today after many bear markets, recessions, wars, interest rate moves, and so forth. So it's never happened. But you're dealing with people who are taught that their biggest challenge in protecting their wealth is to focus on defining risk and safety in terms of protecting their principal from even fluctuating. So the first flawed belief in our belief system is money and currency the same thing. They're not. The only rational definition of money is purchasing power. And because money, the currency doesn't store value. A million worth of the currency units in 20 years, and the mattress is worth maybe, I don't know, 250,000. It's you've lost your money, your purchasing power. You protected your currency, not what you want to do. So the second flawed belief is that risk and volatility, that risk is volatility. Risk is not volatility. Volatility is just up and down movements around the long-term uptrend. And risk is, to me, in this context, the chance that I'll lose my last dollar before I lose my last heartbeat. And by the industry teaching us that I've got to manage my risk and safety in terms of protecting principal, they tell me to have more bonds. And the older I get, have even more and more bonds. The bonds freeze my dollars, my purchasing power in the
Right.
face of 3% trend line inflation.
So you
That's like
invest a million, you get back a million.
you get back a million and you need, $1.5 million, let's say, 20 years down the road.
Because just to be clear, because inflation is eating into the value of that million, so while you preserved your capital, you've basically lost your value.
You preserved your currency and you've lost your money.
That's
So
pretty bad.
right? So what happens is in 30 years, the average retirement, the average couple retires at 62. In year 30, to buy what a million bought today, they need about 2.7 million. So if they perfectly preserve their million in bonds, rolling it over, they long since ran out of money because that unwind the principal to make up for the inflation. And they were eating cat food maybe halfway into retirement. It just
You know what? You're making my prospects sound really, really pleasant. Cat food,
right.
man. I love cat.
No, but you're going to invest the right way. So those are the two flawed beliefs, the flawed behaviors that cause us to make a lot of money mistakes. There's really three categories. One is physiological. It's the fight or flight fear sensor, the amygdala, these organs at the base of our brain shaped like walnuts that basically don't know the difference between a bear in the woods who's going to kill us and a bear market that's temporary, not a real life and death threat. Doesn't know the difference. Treats the two things the same way. It sounds off alarm. So before you get into any psychological and cultural aspects, it's the physical, the physiological thing can kill most people because it's going to tell them to do exactly the wrong thing at the wrong time because it wasn't designed to protect us from temporary threats.
So from being on Wall Street, that means that because they always talk about how the individual investor will always sell the bottom and will always buy the top, and
Right.
that's
That's the
the
reason.
right.
That's
And
one of the reasons. So there's other reasons. So I'll skip to the cultural belief system that's wrong. So economically, we behave culturally almost perfectly rational. So in other words, we behave in a way that's called counter-cyclical, where our demand is counter to price movements. So we're attracted to lower prices to sales, and we're repelled by higher prices. Something goes up in price, we'll substitute for something else, we'll delay the purchase. And we behave that way with almost every economic and financial input except one, the price of stocks. When the price of stocks is high and rising, human nature thinks, wow, if I can pay more for my claim on this company's future earnings and asset growth, I'll actually have a higher return and I'll enter with less risk at these higher prices. And if the price of great companies goes on sale, human nature thinks, wow, it's getting riskier somehow to buy at these lower levels. And my future claim on these earnings and assets is somehow going to be lower if I pay at these lower levels. So in just that one way, we behave pro-cyclically. We're attracted to higher prices and repelled by lower prices, and it's a cultural thing,
makes no
right?
sense. So given the today the semiconductor stocks are getting ripped up, and
Yep.
I'm sure investor sentiment is I got to get out. Whereas if you were more in your behavioral scene,
If you were
it's
diversified and not chasing things and
right,
letting your emotions and your envy and your greed determine your investment policy, yeah, you wouldn't be thinking about that.
right. But
'Cause-
if you're not based in, so not having somebody like you to talk you off the cliff, I should be thinking about buying when if I own the stocks, I'd actually be thinking about selling.
Right. And in fact, if you're doing it the right way and you manage your expectations, you realize that investing successfully is not about finding the next Nvidia or the next Bitcoin or whatever it might be, that might be the highest performing investment for the next 3 years. We don't know in advance, but whatever we think it might be. It's not about finding that. It's about finding the investment that can give you the likely highest average return that you can sustain for the longest period of time. So if someone can just get 7, 8% for the next 30 years on average, they would do better than 98% of their peers. Probably, and I'm probably being conservative, who chase these because the response is I've got to get out because it's something that I've coined. This is not a phrase that's out there, but I coined it. I call it market driven optimism, pessimism bias, meaning I love NVIDIA and the chip stocks yesterday. Now the business model today didn't change. All that changed is the price. So the market price changed. That market price change today, which is negative, gives me pessimism bias about NVIDIA, even though the business and the prospects and AI is all the same thing it was yesterday. So
Yep.
that market-driven pessimism, optimism bias works both ways, and I see it all the time. But when you're diversified and your expectations are, my equity portfolio should make 8 to 10% a year over the next 3 years. In my whole career, it always has, no matter what, for those people who stay with it. You don't think about it. You learn to just that's not my concern. It takes care of itself.
Well, you had given me an example when I spoke to you. You know, you talk about the need to earn returns that outpace inflation and
Right.
that your principal needs to grow. And you'd given me an example of had you bought stocks, $1 million worth of $1 million of stocks 60 years ago, and considering, and a lot of people don't really consider the dividend, how would that, because that's a stark example that really You
Yeah, I'll
know,
give you the example we talked about. I mean, it's a stark example. I use it almost every new person who's interviewing us to figure out if we can help them, right? So in 1960, the S&P was 60. And so a little more than 60 years later, it's 5,600. So my $1 million is now 90 million. But what's critical is inflation went up during that period about 10 times. So I need 10 million to buy what a million used to buy. And stock investing didn't let me do that. It let me do 9 times that. It let me increase my family's asset-based standard of living 9 times inflation. But to your point, back then the dividend yield was about 3.25% or so. So the million was generating 30,000 in income, and the dividend dollar amount that the $2 in dividends divided by 60, that's roughly a 3.25%. Today the dividends dollar amount is $72 or so. So my dividend has gone up about 35 times. Again, inflation's up 10 times. So my cash dividend lifestyle is 3.5 times more than inflation, or I've increased my cash flow standard of living 3.5 times. But what it really means in dollar terms is that my 35,000 today is 35 times that. So my million investment is generating 100% as if it were a bond, earning 100% in income. It's giving me a million or more on my million and growing, and the bond isn't a million today. If I bought a bond back then, so it's 90 million. So the magnitude of wealth destruction that goes on in our industry because of the misperception that we should somehow be concerned about measuring our risk and safety in terms of principal fluctuation, right? And then in the process of doing that, I give you a real life example. In our world, what we do is we tell our investors to keep 2 to 3 years living expenses when they retire outside of equities. So if someone has 10 million and they're spending 4.5%, which is what we'd recommend as a maximum spending rate in a portfolio, they're spending 450,000 a year. We'll tell them to keep about 1 million to 1.2 million outside of equities. Of 10 million, that's 90%. The traditional industry advice to a 62-year-old retiree is going to be keep 40% in bonds. That extra 3 million or 30%, just at 7% of your earnings over their retirement lifetime of 30 years would be 24 million. Instead, the industry advice leaves them with a guaranteed 3 million. Can't go a penny higher.
so let me ask you a question. You did 2 hours of behavioral finance when you were training. And obviously, behavioral finance makes a whole lot of sense. Now, I worked at some of the major wirehouses as a trader, the Shearson Lehmans, the Payne Webbers. If it's so simple, I sat with you for 2 hours and you kind of dispelled what I had garnered over a lot of years. So I'm not going to mention
Mhm.
how old I am, but if it is so commonsensical, why do the wirehouses, why do today's brokerage firms not move in that direction? There's got to be some kind of a financial reason in terms of why it works for them, when in reality, it's really not working for their
For the
client.
client, right? So I think there's different ways to measure how something's working, right? Um, there's a couple of reasons for it. So it's a good question. One reason is that a lot of the advisors, like I was 15 years ago, I was trained. I have 2 master's degrees, an MBA in accounting, a master's in tax, and then an undergraduate degree in finance. And in every one of those curricula, I was trained to believe that risk is volatility. And what I've got to do for my clients is asset allocation, which I don't believe in. I believe in having bonds for the reason we talked about, not for the purpose of muting temporary volatility. And so I don't believe in asset allocation. I believe in what's called derivative asset allocation. What that means is if I've got 2 to 3 years living expenses and I'm spending 400,000 a year put aside in bonds or cash, short-term stuff, then that 2 to 3 years means I'm going to end up roughly 90% equities because $1 million over 10 million. So that's derived. That's not planned. I didn't say, let me be 90-10, let me be 70-30. Not at all. If somebody has 10 million and they're only spending 200,000 a year, they're only going to be 5% in bonds, right? So it's derived. So at the end of the day, what the industry does is out of ignorance, right? That's what we've been taught. So to the extent you want to, you endeavor to be a good advisor, that there's nothing nefarious going on. You're still failing just based on what you've learned your whole life. The second thing is the investor is coming to us not seeking really to get the best return. That's not really what they want. I mean, that's what they say they want. They want the best stock, the best this. We're also taught to, our goal is to outperform a benchmark, the S&P consistently, which no one can do. But what the investor is seeking, in one word, is certainty. As much certainty about their financial future that they can garner. And because certainty can't be garnered, not just in this endeavor, but I always say certainty doesn't exist anywhere as a condition in nature.
Right.
The industry has a choice. Do I tell them that, or do I hand them the illusion of certainty so I can get their money and make money on getting their money? And that's the other problem, right? So the industry knows you don't have certainty. They may not understand that risk and volatility isn't the same thing, and behavior and all that. Forget that. They actually will be more inclined to tell the client the good sounding advice, which is oftentimes not just different, but opposed to the good advice.
Right.
And so what we do is, rather than say, hey, we're UBS, I've got 4,000 analysts, I've got 40 million economists, and we're going to tell you when the recession's coming and tell you when to get in and out of this or that industry, and when the market's going to go down, we'll in advance get out and get back in. Rather than doing that, what we do is we say, no, we're going to not hand you back that illusion of certainty. We're going to teach you how to consistently make rational decisions, given that we'll always have uncertainty, and then understanding what drives the irrational decisions. So the last thing we didn't talk about is the psychological aspect. We talked about the cultural economic aspect. We talked about the physical fear, greed aspect of the amygdala, but we didn't talk about the psychological. I'll talk about it briefly. It's related to what you're asking. So when I mentioned it and I touched on what drives our decisions for financial purposes is not what's going to maximize my wealth in the long term, what's going to minimize my regret in the short term, minimize my chance of loss in the short term, maximize my pleasure in the short term. That's why we chase NVIDIA, right? So at the end of the day, when we understand loss aversion bias, which is one of the key biases in the psychological part of behavior, it says, it's proven, we feel a pain, financial or otherwise, 2.5 times greater than we feel the pleasure of something pleasurable. And so that drives our decision making. In other words, avoiding loss is much more important than gain in driving our decisions. The other thing that's related to that is we are much more sensitive to the change in the value of what we own than to the overall value. So if I've achieved $10 million in net worth and I've hit my goals, I'm much more excited by making the next million than by looking at my 10 million.
Right.
And so because we're much more sensitive to change, and we're much more sensitive 2.5 times more to loss, the strategies we seek out are those that minimize the probability of short-term change. And those are the exact opposite of the strategies that maximize long-term wealth.
Well, as someone who used to bet with a bookie back in the 80s, I know that the pain of bringing him money on Monday was much more painful than winning a game and keeping it on account. So I
Yeah,
don't disagree with anything you're saying, and I also, unfortunately, I think I'm subject to the emotional drivers that are so hindering to the regular investor. So
well, the
you
only
have
way you wouldn't be is if you told me you weren't human. It's human nature. We're all
correct.
subject to it.
So now you mention and you mentioned to me that you charge a fee, but part of that is managing people's emotions. You're
I would say you're onto something. I mean, I would say I have a schematic sometimes that I'll lay out for a client who's asked me about our fees and what the fees are for and so forth. And I say for market timing, the fee is zero. For purchasing the securities, the fee is zero. For planning, it's 20% of my fee, which is just under 1%.
right.
And for behavior is 80%. So not it's just that we charge some of our fee for behavioral counseling. The bulk of the fee goes to behavioral counseling because that's the bulk of the value.
Yeah, absolutely. So on a when there's a crisis, when the news is what the news is, I'm sure you get calls from clients
Oh,
who need to be talked down.
We don't as many as we used to. I say my compliance officer who joined us maybe about now 6, 7 years ago came from a much smaller firm, and he used to get calls all the time coming into his office, the compliance, because people were unhappy about performance and they're not beating the index or they're not this and they're not that. And he said even in good times, it was just, he said here he came and he went through 2020. He was amazed. We had 4 or 5 calls out of 300 families
That's
because
amazing.
what we do is we do the lifeboat drill long before the bow touches the water. What we do is not reactionary. We believe strongly that surprise is the mother of panic. So it's very important during the onboarding interview and then the onboarding process to reiterate to people all of the things we talk about. Expect to watch 15% of your money in stocks appear to disappear each and every year, twice that amount 1 year in 5 or 6. If you can't look at that stoically and let your plan continue the way we mapped it out, don't invest in equities, buy CDs, you'll never make it. It's just
Interesting.
that simple. It's
So
that
you,
simple.
so you do have people who come to you who are not
We can't help
seeking,
them.
right,
We can't help them. Right. We say it as politely and professionally as we can, but they would be a rented client. If we find ourselves getting into the discussion of, uh, you know, the market declines are temporary and they're nothing to be concerned about. And they say, okay, but you do use stop loss orders, don't you? I turn into what my mentor taught me is the great waiting room where, when the sun rose over the Republic today, there were about 40 million people between the age of 50 and retirement. That's who need us because this 50 is a magic number. Most people don't plan. And then when they hit 50 and they realize they're only going to be working another 10 or 15 years, some bell goes off. And they say, I got to start planning and saving and spending and doing whatever, spending less, doing whatever. But those people, the 40 million, maybe 20 million can hire a professional. Those are the people in my waiting room because we practice as a medical kind of practice and
right,
they need the help. So the person
absolutely,
who just said what they said, you do use stop loss orders. My mentor said that wasn't the person speaking. That was God speaking to you. And what he was saying is look to your waiting room and say, next, because
that's
there are
good,
people, and that, that always resonates with me. So yeah, you have to, you don't want to waste their time and you
right,
don't really want to waste your time. You get to a point where based on the interview, you're really interviewing them if you're doing it properly to see if they
right,
can make it. Because otherwise I'm just like everybody, not everybody else, but I'm like a lot of people in the industry who will just do anything to take a fee. I don't want a temporary fee. I want to help the person and get paid for that. I
so
don't want to
now
rent the client.
what is your minimum investment?
So right now it's $5 million
Okay,
uh, invested with us.
okay, that's fair.
That's the minimum investment. Yeah.
That's great. I mean, I gotta tell you, it's again, if people are listening to this who are not focused on inflation, who are not focused on having their money grow as they need to, because whatever they're buying today is going to cost that much more tomorrow, and we've seen a 3 year compression of that situation, and over the next 30 years, you can't even imagine what your 1 million today needs to be in order to live the
Right.
same.
It legally needs to be almost 3 million. I mean, approaching 3 million. So it's hard to imagine that. That's, there's something also related to that called hyperbolic discounting. So, I've always had an eating disorder. I gain weight, I lose weight, I gain weight, I lose weight. If I go to the doctor and he says, Jonathan, if you eat hamburgers and cheeseburgers and you
Mm.
keep doing it the way you're doing it, in 10, 15 years, you're going to have a heart attack. And you leave his office and you eat a hamburger because 10, 15 years, I worry about that in 10, 15 years, right? I want to enjoy. It's the same thing with investing, right? So we discount the chance of something happening the farther away it might be. And so that's why people go out and buy the Bentley when they need to save for retirement instead, because I worry about 20 years in 20 years. And then suddenly 50 comes and wow, boy, did I mess up.
So it's almost like people need to come to you and be prepared on some level to getting out of their comfort zone.
You have to be because, what you really have to, what I always say to people is you've got to make a decision on which side of your financial life you're willing to accept uncertainty so that you may have a greater chance of certainty on the other end,
Yeah.
right?
Listen,
If you
I
want that certainty when you're 30, 40, 50, and even 60, because you still have 30 years to go, you better just be prepared to eat cat food 20 years from now. On which side of your financial life do you want certainty so that it's uncertainty so that you can have more certainty on the other end?
You know what? It made 100% of sense when I spoke to you, and it really does make 100% of sense now. And I think that for
I'm
anyone
glad.
who's listening, if they want to reach out, how would they do that?
So the best is go on our website, which is www.fusionfamilywealth.com. And our
Terrific.
phone numbers are there, our articles, which are very helpful to people. Even if they're not hiring us, it's great for them to read it, to understand. We kind of give, in the context of current events, how to think behaviorally and rationally about what's going on. So for now, a lot of people are wondering, the whole country thinks democracy is about to end. Half think it's if Biden wins and half think it's Trump wins, but the whole country thinks democracy is about to end. So that's what they're concerned about now. So I got a call last week and said, well, what if this happens? What if that happens? And aren't you worried? And I said, no, I'm not worried, but let's talk about it. I said, well, your plan is designed for the next 2, 3 decades.
Right.
So the focal point is the next 20 years and the 10 years on either side of it. What in the world does who wins presidency in 6 months have to do with that? Or inflation, or when they reduce interest rates, right? So you have to get people off of that, constantly reacting to current events and short-term market moves, and always acting on their plan. Most people, the problem is they don't have a plan. You need to have a date-specific and dollar-specific plan. In other words, but Jonathan, by age 62, in 6 years, I need 300,000 a year. What's the principal sum I need to accumulate? How will I get there? Most people don't even have that. And Yogi Berra said it best: make sure you know where you're going, because if you don't, you might not get there.
The other one that makes a little more sense than Yogi Berra is if you don't if you
If you
fail to
don't plan,
plan,
fail to plan, if you fail to plan to fail,
thank you very
right?
much.
The other thing I've heard, and I'll leave you with that thought, is someone once said to me, so you're telling me if I have a plan, I'm guaranteed to make it. Someone once said that. And I said, I'm not telling you that. What I'm telling you is if you don't have a plan, that's the closest thing to a guarantee of failure.
True. And one other thing that I always tell my kids, because uh, two of my kids have a problem with using the phrase you just used, which is "what if," and what if, especially when you're talking about situations, you never extrapolate them to the best possible outcome, always to the worst possible outcome, and
Yeah.
it's a phrase that really needs to be taken out of a lot of people's
Well,
vocabulary.
you're right. And, when you talk about that, what comes to my mind is the word unprecedented. So a lot of people who don't engage in history, everything seems unprecedented. Truman said the only thing new is the history you don't know. And it's most of the time that's true. But when we talk about what if, what I call that is, from the investors coming in, the what if, it's always an apocalyptic speculation.
Always,
The
always.
dollar's gonna, what if the dollar's no longer the reserve currency? What if there's a nuclear Armageddon and because of Russia? What if? And I say to them, look, I'm not going to tell you those things can't happen. They certainly can. What I'm going to tell you is you can't marry a plan to apocalyptic speculation. And
Right.
in my career, anyone who's tried, they buy cash, gold, whatever, they've found themselves in a world that didn't end in an apocalypse, but they created a financial apocalypse because the investments they made didn't prepare them for a world that didn't end.
Well, I'm going to leave it on this last thing. And first, let me say, Jonathan, phenomenal. People should go to his website and watch your 15-minute video of similar to what we discussed today, but much more of a step by step in terms of why it is and how it results. But the last thing that I'd like to say is, you talk about guarantees, what ifs, apocalyptic endings. I was never in a 12-step program, but for each one of my kids, I got them a replica of the Serenity Prayer, and I think that's something that investors and everybody else should look at every morning when they wake up because it's a good lead into your day. But Jonathan,
Thank you. I haven't myself, and I will. Thank you, Mike.
you do. No, good,
No, I
good.
said I haven't, but I will now that
Oh,
you've mentioned it. Yeah, thank you.
good. No, it's very worthwhile. But thank you very much. You're a great guy.
You too. Thanks, Mike. I really appreciate it.
All right, and I hope to see you soon.
Likewise.
Whoops. All right.
Welcome to Do.
All right, that's that's live TV, Jonathan.
Thank you for listening to Do You you ever wonder? And we hope that you enjoyed the show. Next week, we will have another terrific guest telling their story. And if there are any specific topics you'd like to hear more about, please don't hesitate to let us know. Our curiosity, like yours, knows no bounds. Please subscribe and like and share this episode on your social media. See you next week.